G'day, Michael Beresford here from OpenCorp, along with OpenCorp Group CEO Matt Lewison. Great to see you today, Louis. How are you?
Yeah, great, boss. Great, boss. Great topic for us to talk about.
Yeah, it's juicy. It's got a fair bit to it. So let's crack in. What sort of returns would you expect to get from investment property? Is one of the most common questions that my team and I hear from people that are interested in investing. So there's a fair bit to that in terms of the actual return and then how you do it well to maximize those returns. So why don't you kick off? Why does residential property work and what do the returns look like over history?
All right. Well, it's a bit of a trick question, Boz, because often people use this to compare returns from property to returns from shares. And we know it. I mean, first of all, residential property has outperformed pretty much every other asset class in Australia over the last 60 years. But you're also not comparing like with like. So it's already winning on a general total return basis. But that's not just factoring in the equity. That's the total value of the property. And we know that residential property can be geared a lot more than other asset classes. So where somebody might, use cash to buy shares or potentially gear it to 50%, you can gear a residential property to 80, 90% because the banks see it as a much safer asset class. And that's largely because consistent returns and stability. Now, if we talk real numbers on a total return basis, the Australian property market's achieved about a 9% per annum return over the last 18 years. And there's been very few years that were in the negative compared to shares and other assets that, went up and down quite a lot. But if we talk more specifically about OpenCorp's client, they've made an average of 11% per annum on the total return of the property portfolio. But again, that's not quite the full story because somebody who invested in 2006, for instance, buying a house for $260,000 with just $52,000 of equity, they've actually made over 1,000% return on their cash in the 18-year period. It works out to well over 30% per annum on cash return for those investors. But again, that's not quite the whole story because those clients were also able to buy a second property and some of them even a third property, getting compound returns. And they only ever put in that first $52,000 of cash. And they were able to use the equity growth from their first and then their second property to buy more properties. So the returns that they've been able to achieve, that's astronomical, more than 2,000% return on their cash in that 18-year period. And I know 18 years can seem like a lot, but when you break it down into 5-year periods, it's kind of just, your first property maybe in the first year, maybe a second in that 5-year period. But yeah, over 10, 15 years, it makes a huge return for investors. So look, I can talk all day about the returns, about property selection and why that might be different. But, you talk to property investors day in, day out, you see the difference between some investors, what they're able to achieve and others who don't quite achieve the same result. What are the key things that you and your team see that make all the difference?
Yeah, great. Look, there are a few key things. The first one is a mindset related thing. The rest are kind of related to the property. So as you talked about, the power of, we call it leverage, right? The ability to put in, let's say 100 or 200,000 as a deposit and costs and borrow the rest from the bank. The borrowing the rest from the bank is what we call leverage. And obviously it gives us a much greater asset value that we then get, 11% growth on per annum for our clients. Now, the reason why most people struggle with this concept is because the way that we've been brought up is that debt's the devil, right? Don't have debt, debt's horrible. What we educate our clients about daily is the fact that owner-occupied debt is very, very different to investment debt. And those that understand this concept go on to build really, really successful portfolios and change their life. So if we start with that, if you've got a debt on your own home, then the only source of money that you've got to repay that debt is your post-tax salary. So every single cent's coming out of your pocket. Whereas if we look at investment debt, the properties that we're sourcing for clients are giving them a $55,000 pay rise compared to the money they've got in their pocket right now in the form of $35,000 to $40,000 a year in rental income that the tenants are paying them to live in the property, plus $15,000 to $20,000 in tax benefits each year. That's money that they're not currently seeing. So Leverage is a really, really important concept. Owner-occupied debt can be can really hamstring you because it takes so much cash flow. Investment debt is very, very different. So let's kind of break down, I guess, the growth and cash flow components there, because so many people come to us and say, oh, I want a cash flow focused property, or I want a capital growth focused property. And we're forever helping them understand that you can actually have the best of both worlds. We don't subscribe to the fact that you've got to have one or the other and sacrifice the other one to get the other. So without doubt, as you talked about, right, 11% capital growth or 11% return is going to provide so much more wealth creation than a few extra $1,000 of rent coming in each year. And specifically, one property, I've never known a client to be able to achieve their financial goals based on having one investment. They don't need a massive portfolio like Steve McKnight used to tell everyone. You need 120 properties in 3 weeks, or whatever he called his book. But you do need to understand a process where you can acquire a handful of high-performing properties. And when we talk about high-performing, what we mean is capital growth focused with a really strong cash flow, so you're not impacting your lifestyle, and you can easily hold 2, 3, 4, or 5, or whatever it might be over time. So let's look at the different forms of cash flow. If we've got a capital growth focused property, what does the cash flow look like to be able to hold that? Well, the first one is the rent. We want a really strong rental yield. We want to be in areas that have a really high demand for tenancy and a really low vacancy rate, because supply and demand means we can drive the rent up higher than that. A client of ours got their property leased 2 days ago in Perth. We budgeted on 600 a week, and we actually got 800 a week signed yesterday. So there's an extra $10,000 that Mitch has got in his pocket that he wasn't budgeting on to be able to hold that property. And lo and behold, the conversation yesterday was, how do I get my next one? Because, you know, I could hold it for the same cash flow I was budgeting on just holding the first. The second is the tax benefits. Now, this is critical because not every investment property is created equal. There are some properties where you can get no tax benefit. There are some properties that you can get $20,000 a year or more in tax benefit. Obviously, we do the latter. That's a whole separate conversation, longer than today. But what I will touch on is the power of depreciation. Most costs to do with an investment property are tax deductible. Depreciation gives us extra tax benefit at no extra cost. It's just about being smart about what we buy. Okay, so if we can get an extra, let's say, $15,000, $16,000 worth of deductions through depreciation, work that out on your marginal tax rate. But for most people, that's going to be around $5,000 to $6,000 extra tax benefit each year. That equates to about $120 a week. That can hold you another property. So just think about, if you'd been smart about what you bought and that allowed you to buy 2 properties 10 years ago compared to 1, you can see why we call depreciation, the major power factor here for cash flow, because you'd be hundreds of thousands of dollars, better off in that same period of time. The final component that we need to consider over and above leverage, rental, and tax benefits is what we call lazy equity. Lazy equity is the horsepower behind being able to grow a portfolio. As you said, our clients put a cash deposit into their first property if they don't have their own home to leverage equity from. But this was one of my big light bulb moments early days, was I put cash into the first one and I didn't have to put any cash into the next one because I just borrowed that equity and I used that to pay the deposit and costs. And then I had 2 properties going up for me, so my wealth creation happened even quicker. And then lo and behold, lather, rinse, repeat, use the equity again, and we're off and running. So one of the first things that investors need to understand is, how much lazy equity do I have in my own home or in an investment property that I currently have? Harness that, have the interest on that equity covered from the rental income and the tax benefits, and that allows you to hold a property that's capital growth focused with very little cash flow out of your pocket week to week. And because of the vacancy rates around the country right now and the rental growth that we're seeing, just like Mitch's property I talked about, it might start out costing you $100 a week or thereabouts in year 1. Very, very quickly, within a couple of years, it's probably paying for itself anyway. the growth's for free, and you can add your next property, and that's how we get serious wealth creation and compound growth our returns by buying the right kind of property, using leverage and cash flow to our advantage. And if we pick the right areas, then as you highlighted, we're just able to turbocharge the results for our clients.
Yeah, I'll tell you some like mind-boggling things right now, Boz. 70% of Australian property investors only end up owning one property. So only 30% own two or more. 80% of property investors in Australia who borrow money to buy a property are actually borrowing money to buy an established or an old house where they get very little benefits from depreciation. So they're missing out on a lot of these tax benefits, which is, again, one of those reasons why I think a lot of property investors don't get past number one.
Yeah.
But OpenCorp's clients are 150% more likely to own two or more properties than the average Australian investor. And again, it comes down to having a structure, a strategy, having, tactics that are aligned to each individual. So it's not one size fits all. It's looking at what somebody's income, what's their tax position, what's going to get the best outcome, and enable that person to be able to duplicate sooner and grow an actual portfolio that makes money. But I think, it's not rocket science about, as you said, lather, rinse, repeat, doing the things that you know are going to work. It's not a guessing game, but so many Australians just, take a punt and go out and don't really do the research they need to do to get it right. But anyway, I love the data, and I think that just kind of speaks for itself, I think, in terms of Australia's property investment market.
Couldn't agree more. I think that the one key takeaway point to finish on with people out there is, there is a proven process that works. Get in touch. We'll teach it to you. It's not rocket science. It's just a bit of a different way to investing that most people think about. But obviously it brings a very, very different set of results. Fundamentally, there's an easy way to do it. You just need to understand what that is and execute it. It amazes me that people spend $1 million on an investment property based on 5 minutes research walking past a real estate agent's office. That proven formula can turbocharge your results. And the really powerful thing, as we saw with Mitch's example I just shared, he's starting to see a benefit in year one. A lot of people talk about changing your life and retirement long term through property. Yes, it's a long-term investment, but you start to see the benefit really, really quickly. And that allows you to duplicate and reinforce that benefit really, really quickly to the point where, in 3 to 5 years, you can set yourself up financially and be really well positioned to be in a much better financial position. So always great to chat to you, Louis. Thanks for joining us. We'll see you next time.
Thanks, guys.